As we approach 2026, it's time to check out changes from the Canada Revenue Agency. We are joined by Jamie Golombek, Managing Director of Tax and Estate Planning at CIBC Private Wealth. Jamie, always great to see you. You always bring us the real goods. So the tax brackets are adjusted upwards with inflation. Just remind us of the big changes then for next year, please.
Yeah, so not a lot of changes for next year. Probably the biggest one, of course, is the full indexation of the tax brackets. So each year, the tax brackets are indexed to inflation. They've just announced last week that the inflation adjustment factor federally will be 2%. So all the brackets will be going up by 2%. The other important thing to remember is that earlier this year, over the summer, the government lowered the tax rate for the lowest bracket. That's income up to around $58,000. And they've dropped it from 15 to 14.5% for 2025. And on Jan 1st, that drops further to 14% for 2026.
So that's income up to just over $58,000. You'll be at that low rate.
Yeah, right. 58,523 will be the number for next year.
Right. And then we can't go into all of it, but then from 58 to 117,000, you're at 20.5%.
That's exactly right. We go right up to that very, very top bracket federally, which is 33%, and that next year will be income over $258,000. Just an interesting point. I mean, if you look at the U.S. federal rates, with the recent Trump proposals in the U.S. that passed in the summer, their top rate is 37% federally, but that kicks in at over 600,000 U.S. dollars, which is about 880 Canadian. So just to put it in perspective, our rates, are not that crazy with federally, but obviously we kick in at a much lower rate than the U.S. does.
And then, of course, the provinces have to have their pound of flesh as well.
They sure do. The provinces all levy much higher taxes than, of course, the state taxes in the U.S. And, of course, we're talking to some clients that moved to Florida. Florida doesn't even have a personal state income tax, so your top rate is 37, whereas the top rate in Ontario or BC is 53.5%.
Yeah, Florida. I don't know if I could handle the heat, but I wouldn't mind that low tax rate. Yeah,
that's right.
Remind us about that old basic personal amount. This is the amount you can earn without paying any tax.
Well, that's right. So the basic personal amount, every Canadian has that. Every individual taxpayer has that. And for 2026, that number is going up to $16,452, meaning that any income up to that amount will not be subject to tax. That credit, of course, is at the lowest rate. That lowest rate is 14% for 2026. And so that credit, however, is reduced if you're sort of in a higher bracket. So, for example, they've introduced a sort of phase out, which means that taxpayers that have a net income over $181,000, which is the bottom of the fourth tax bracket for 2026, will actually have it phased out up until they get into that top bracket of $258,000. So not everyone will get the full benefit of the basic personal amount if your income is relatively high.
And tell us what's happening with the Canada Pension Plan contributions. Are they indexed as well?
Yeah, so everything is indexed, and again, the rate is staying exactly the same. The exemption amounts have gone up. Not the exemption, but the yearly maximal pension earnings have gone up. Of course, there's two levels of CP. Those are all, fully indexed, and all that information is available readily online.
But you're earning CPP benefits on only a portion of your income. That maxes out at around $74,600. Is that it?
Yeah, exactly. So there's two levels of earnings, right? So there's the first level we've had for years. There's sort of that's what we call the second earnings level, and that number is up to $85,000. So there's a sort of a second level of employee and employer contributions required, and that gives you an extra CPP2, we call it, benefit when you retire.
I didn't know this, that the self-employed people pay 11.9% CPP contribution. It's quite a big chunk, isn't it? About 12% of your income.
Yeah, well, that's right. Well, if you think about it, right, if you work for an employer, like I work for CIBC, I pay my half and CIBC pays the other half. So there's an employee and employer portion. If you are self-employed, then, of course, you've got to pay both portions of the CPP.
Before we let you go, is there any changes to tax-free savings accounts or RSPs that we should have on our radar?
Unfortunately not. TFSAs are indexed to inflation, but they are also rounded to the closest $500. So with inflation only being 2% this year, unfortunately, that wasn't enough to put it to the next threshold. So they've confirmed that the TFSA contribution limit for 2026 will remain at another $7,000.
Right, and we should remind the viewers that first home, that newish first home buyers plan, it has the advantage of both an RSP and a TFSA, flexible, but also you get relief when you put money in. You should get your name into the system before year end. Can you remind us about that?
Yeah, absolutely. With a first home savings account, the FHSA, to be able to get the contribution room of $8,000 per year, you actually have to open up an account. So our advice is to anyone who qualifies as a first-time home buyer, meaning no home in the current year and the previous 4 calendar years, you have to open up the account before the end of the year, even if you don't put any money in it, to get the $8,000 of room for this year, which means that next year you get another $8,000 plus an $8,000 carry forward. If you waited till January or later to open up the account next year, you can only put in $8,000. So good idea to at least open the account before December 31st this year if you're a first-time home buyer.
So if people have young adult sons or daughters, get on them.
Absolutely.
Well, in my experience, you have to get on them and stay on them to get them to do anything like that. Anyway, Jamie, thank you very much. Jamie Golombek, Managing Director of Tax and Estate Planning with CIBC Private Wealth.